Lesson 4 is let's look at a sample company, Intel in this case. We're going to do a lot more in later lessons about financial statements, but this is just an introduction from how we go from just the concept of the statements to the actual statements themselves. So Intel has a full set of financial statements, which we have in the Excel sheet that's attached to this lesson. We'll start breaking into those statements. Let's start with the balance sheet. That's the balance sheet. Oh my God, so many lines, so many technical terms. I don't understand it. So let's, for this purpose, let's go to 30,000 feet. And let's just pluck out a few numbers to see what's going on. So in this Intel balance sheet, we can see their total assets, their total liabilities, and we see how they're doing from year 2018 compared to 2017. On the right side, we see these numbers we drew from the left, and we have these totals. One example of a ratio that we're going to use to analyze is what is the ratio of liabilities to total assets. In other words, of all the assets you have, how much of those were financed by liabilities? So in 2017, it was 44%. In 2018, it went down to 41.7%. So what that means is that 41.7% of the assets in 2018 were financed compared to a higher number the previous year. The interpretation, the amount of debt or amount owed as a percent of assets is declining, which generally means the company is safer from risk of default. If our debt keeps rising, we owe more and more money to outside people, we're putting ourselves at more and more risk. Conversely, if our liabilities are dropping, we're now reducing the risk in the company. All right, next, income statement. Again, a bunch of jargon, some words you may know or not know. Let's break it down with some key numbers. So from 30,000 feet, let's just look at the big ones. Total revenue, which are sales. Total net income, which is profit. And let's grab those two numbers right here for 2017, 2018. And then let's do a ratio of net profit margin, which is dividing net income by revenue. And we get these ratios. In 2017, on $9 billion of income and $62 billion in revenue, they earned 15.3, which means for every dollar of revenue, they earned 15 cents. In 2018, it got better. For every dollar of revenues they earned 29 cents, almost a doubling. So this is a very promising and impressive performance in that year because their earnings per every dollar went up by almost double. So that's a substantial improvement. Next, statement of cash flows. Oh my God, really? Those many words? Those many lines? So let's, again, go up to the very top and look at the key numbers. Here we're just going to look at the subtotals of cash that's generated from operating, investing, and financing, the three activities that are comprised in the statement. And we pull those numbers from the left side. And what we see is that they generate a lot of money. In 2018, they generated $29 billion in cash from running their business. What did they do with all that money? Well, they invested $11 billion back into their property, plant, equipment, and probably set some money aside in investments. And they also did some things, negative financing. We were able to see that they were able to invest in their future and pay money to their various suppliers of capital. Statement of stockholders' equity. Last one. Again, guess what? We'll go to 30,000 feet. So let's look at some key numbers here. And here we see certain numbers from shareholder standpoint. How much profits did they earn? How many dividends did they pay? And did they repurchase shares and how much? And so these are some of the numbers extracted from this. So what does that mean? That means we earned a lot of profit. We already saw that previously. Next, we paid a lot of dividends to shareholders, both in 2017 and 2018, about $5 billion per year. And importantly, they've been repurchasing their own stock. So they use money that they have in the company, went to the open markets, the public markets, and bought back Intel shares to the tune of $3.6 billion in 2017 and $10.8 billion in 2018. Now, why would they do that? Well, by buying stock back in the company, that means those who still own the stock have a higher percentage ownership in Intel. So the stock value will rise. So now if you're a shareholder, you're very happy. You got cash dividends because the cash is generated by the company in large measure. And your share price is rising because the company is systematically buying back shares out of the market so your share price goes up. So I think you're a happy camper, aren't you? By having dividend and share price going up. Now, this is only if the markets still love what Intel's doing. A dark cloud that we'll cover in a future lesson. Summarizing the topic of financial reporting and basic financial statements. Lesson 1, we looked at accounting standards as set in the US by FASB, resulting in GAAP, and as set by the IASB for other countries, leading to IFRS. Lesson 2 is users of financial statements. It's all over the place, from investors to shareholders to customers to suppliers to the community at large. And each of them has a reason to be interested in seeing how the company's doing. Third is the accounting equation and the basic financial statements. Assets equals liabilities and equity. Oh, got that. 4 statements are balance sheet, income statement, statement of cash flow, statement of shareholders' equity. Hopefully, got that. Finally, we looked at a company, Intel, that's big and maybe complicated. And we're seeing that as complicated as it is, even with limited knowledge of financial statements and accounting, we can extract high-level numbers and get some view of how the company is doing. In future topics, we're going to go much deeper and hopefully get you to a place where you're able to analyze a company and assess for yourself their financial performance and their financial health, right? See you soon.